They crashed silver on purpose. And I can prove it. February 5th, 2026. Silver drops 16% in a single day from $91 straight down to $78. The financial media calls it panic selling. They say it's speculators taking profits. They say it's a correction after a parabolic rally. But that's not what happened. Because while silver was crashing, something else was happening that nobody is talking about. COMEX registered inventory didn't go up. It went down. Physical premiums didn't collapse. They went up. Chinese buyers didn't sell. They bought more. And industrial demand didn't slow. It accelerated. So if physical demand is strong, if supply is tight, if fundamentals haven't changed, then why did the price crash 16% in 24 hours? Because someone wanted it to. Someone needed it to. And I'm going to show you exactly who, exactly why, and exactly what happens next. Because this isn't a crash. It's a setup. And if you understand what's really happening, you won't panic sell. You'll do the exact opposite. Let me show you the evidence. Look at the timing. January 20th, 2026. Silver hits $120 per ounce, an all-time high. Retail investors are euphoric. Reddit is going crazy. Twitter is full of silver to 200 predictions. CNBC is running segments on the silver squeeze. And then what happens? January 21st, the selling starts. But it's not retail selling. Retail doesn't have the volume to move silver 16% in one day. This is institutional. This is algorithmic. This is coordinated. And here's how I know. During the crash, futures volume spiked. Over 100,000 contracts traded in a single hour. That's 500 million ounces of paper silver. But COMEX registered inventory is only 113 million ounces. So 500 million ounces of paper traded, while only 113 million ounces of physical exists. That's not organic selling. That's manipulation. That's someone using the paper market to crush the price while the physical market stays tight. And here's the kicker. During the crash, bid-ask spreads widened. That means liquidity dried up. When liquidity dries up, prices fall faster. And who controls liquidity on COMEX? The market makers, the big banks, JP Morgan, HSBC, Scotia-Mocatta, the same banks that were fined for silver manipulation in 2020, the same banks that hold massive short positions in silver futures, the same banks that profit when silver falls. So let me ask you a question. If you were short 500 million ounces of silver and the price just hit 120 and you're sitting on billions of dollars in losses, what would you do? You'd crash the price. You'd dump paper contracts. You'd trigger stop losses. You'd force margin calls. You'd create panic. And then when the price hits 78, you'd cover your shorts at a 50% discount. That's exactly what happened. And I'm going to prove it with the data, the evidence. Let's start with the short position data. The Commodity Futures Trading Commission publishes weekly commitment of traders reports. These reports show who holds what positions in silver futures. And the data from late January 2026 is shocking. Commercial traders, which include the big banks, held net short positions of over 250 million ounces of silver. That's the highest short position in over 2 years. Now, why would banks be massively short silver right when it's rallying to all-time highs? 2 reasons. Either they're hedging physical inventory or they're speculating that the price will fall. But here's the thing. Most of these banks don't have physical inventory. They're not mining companies. They're not refiners. They're financial institutions, which means they're speculating. And when you're short 250 million ounces at $120 and the price keeps going up, you're bleeding billions of dollars. Every $1 move costs you 250 million. So from 100 to 120, that's $5 billion in mark-to-market losses. And if silver kept going to 150, 7.5 billion in losses. To 200, 20 billion in losses. At some point, you have to act. You have to stop the rally. And the easiest way to do that is to crash the price in the paper market. Now let's look at the physical market, because this is where it gets interesting. On February 5th, the same day silver crashed 16%, physical dealers reported record demand, APMEX, JM Bullion, SD Bullion, all reported website traffic spikes, phone lines jammed, orders backed up. And premiums? American Silver Eagles, which normally trade at $3 to $4 over spot, were selling for $9 to $12 over spot. That's a 200 to 300% increase in premiums. Now think about that. The paper price crashed, but physical demand surged, and premiums spiked. That's the opposite of what should happen in a normal market. In a normal market, when price crashes, demand falls and premiums collapse, but that's not what happened, which tells you the crash wasn't driven by fundamentals. It was driven by paper manipulation. And then there's China. On February 5th, while silver was crashing in New York, Shanghai was buying. Shanghai Futures Exchange reported inflows of physical silver. Chinese premiums widened to $15 to $20 over London spot. That's unprecedented. Chinese buyers were paying $20 more per ounce than the global price just to get physical metal. Why? Because they know. They know the paper price is fake. They know the physical market is tight. They know that when the squeeze comes, having physical metal is all that matters. And they're willing to pay a massive premium to get it now. So while Western paper traders were panic selling at $78, Chinese physical buyers were panic buying at $98. That spread tells you everything you need to know. The paper market and the physical market have disconnected. And when that happens, the paper market always loses, always. Now let's talk about COMEX inventory, because this is the smoking gun. On February 4th, the day before the crash, COMEX registered inventory was 113 million ounces. On February 6th, the day after the crash, COMEX registered inventory was 109 million ounces, 4 million ounces withdrawn. During a price crash, that's not normal. In a normal crash, metal flows back into the warehouses, people sell physical, deliver into COMEX, inventory goes up. But that's not what happened. Inventory went down, which means even at $78, physical holders aren't selling. They're holding. And in some cases, they're buying more. So you have a situation where the paper price says silver is worth 78, but the physical market says it's worth 90 plus, and that gap is widening, which brings us to the real plan. The real plan. Here's what they're doing. Step 1, crash the paper price to shake out weak hands. Retail investors who bought at 100 or 110 panic. They sell at 80 or 75. They take losses. They leave the market. Step 2, trigger stop losses and margin calls. Leveraged traders get liquidated. Their positions get closed automatically. That creates more selling pressure, more downward momentum. Step 3, cover short positions at lower prices. The same banks that were short at 120 now cover at 80. They lock in $40 per ounce profit on 250 million ounces. That's $10 billion. Step 4, accumulate physical at suppressed prices. While retail is selling paper, institutions are buying physical. At $78 with premiums at $12, they're paying 90 per ounce for physical. Still cheaper than 120, and they're getting actual metal, not paper promises. Step 5, wait for the physical squeeze. Once they've accumulated enough, they let the price run. And when it runs, it doesn't stop at 120. It goes to 150, 200, 250. Because now the shorts are covered. Now the weak hands are out. Now the physical is locked up. And now there's no supply to meet demand. This is the same playbook they used in 2020. In March 2020, gold and silver crashed during the COVID panic. Gold fell from 1,700 to 1,500. Silver fell from 18 to 12. Everyone said it was the end of the precious metals bull market. But what happened next? By August, gold hit 2,000. Silver hit 29. Why? Because the crash was a shakeout. The big players used the panic to accumulate, and then they let it run. And the same thing happened in 2011. Silver hit $50 in April and crashed to 26 by September, a 48% crash. Everyone said the bull market was over, but what happened? Silver rallied back to 35 by February 2012, and it stayed elevated for years. The crash was a reset, a way to flush out leverage and weak hands before the next leg up. And that's exactly what's happening now. But here's the difference this time. In 2011, there was no supply crisis. COMEX had 300 million ounces of registered inventory. Now it has 113. In 2011, China wasn't restricting exports. Now they are. In 2011, industrial demand was 300 million ounces. Now it's 680. In 2011, there was no solar boom, no EV revolution, no AI data centers. Now all three are consuming silver at record rates. So the setup for a squeeze is 10 times stronger than 2011, which means when this runs, it's going to run harder and faster than anything we've seen before. The crash to 78 isn't the end, it's the launch pad. And the big players know it. That's why they're accumulating. That's why China is hoarding. That's why physical premiums are spiking. They're all preparing for what comes next. Now let me show you the timeline. We're in early February. The crash just happened. Physical demand is surging. Premiums are elevated. COMEX inventory is draining. China is still restricting exports. Industrial demand is still growing. By mid-February, we'll see if COMEX inventory drops below 100 million ounces. If it does, that's the first trigger. By late February, we'll see February delivery data. If delivery demands are high, that's the second trigger. By March, we'll see if China extends export restrictions into Q2. If they do, that's the third trigger. And by April, we'll see if solar installations stay above 150 gigawatts. If they do, that's the fourth trigger. If all four triggers hit, silver doesn't stay at 78. It goes to 120, then 150, then higher. And the institutions that crashed it to 78 will be the ones riding it to 200. While retail is on the sidelines, licking their wounds, wondering what happened. That's the plan. Crash it, accumulate, squeeze it, profit. And retail gets left behind, unless you see it coming. What you should do, so here's what you do. First, don't panic. If you own silver and you bought below 80, you're fine. Hold. If you bought above 100, you have a decision to make. Cut losses or hold for the long term. If you believe the squeeze thesis, hold. Average down if you can. But don't sell at 78 out of fear, because that's exactly what they want. They want your metal. They want you to sell physical so they can buy it cheap. Don't give it to them. Second, watch COMEX inventory. This is your number one signal. If registered inventory drops below 100 million ounces, the squeeze is on. If it stays above 120, the squeeze is delayed. Check CME Group's website daily. The data is public. It's free. Use it. Third, watch physical premiums. If premiums collapse back to $3, that means physical demand is fading. Bearish. If premiums spike above $15, that means physical shortage is intensifying. Bullish. Check dealer websites, APMEX, JM Bullion, SD Bullion. Compare their sell prices to spot. That spread tells you everything. Fourth, watch Chinese export data. February data will be released in mid-March. If exports are down another 40%, China is still hoarding. Bullish. If exports normalize, the restrictions are easing. Bearish. Also watch Shanghai inventory. If it keeps falling, domestic demand is strong. If it stabilizes, the frenzy is over. Fifth, watch the commitment of traders report. Every Friday, the CFTC releases updated data. Watch the commercial net short position. If it drops below 200 million ounces, the banks are covering. That's bullish. If it stays above 250 million, they're still short. That means they might try to push prices lower again. And finally, have a plan. If you're long silver, set your stop losses. If you're at 78 and you can't stomach a drop to 60, set a stop at 70. If you don't own silver and you're thinking about buying, scale in. 25% at 78, 35% at 70, 40% at 60. Don't go all in at once. Average your entry. Keep some cash for lower prices, because they might try to crash it again. They might push it to 70, to 60, to 50. If they do, that's your gift. That's your opportunity to load up before the real squeeze. Because the lower they push it, the faster inventory drains. The faster premiums spike. The harder the squeeze when it comes. They can manipulate the price. But they can't create physical metal. And that's the key. Paper is infinite. Physical is finite. And when the physical runs out, paper becomes worthless. That's when the real price discovery happens. That's when silver goes to 150, 200, 300. And the people who held through the manipulation are the ones who win. The verdict. So here's my honest take. They crashed silver on purpose. The evidence is overwhelming. Massive short positions, coordinated selling, spiking physical premiums, draining COMEX inventory, Chinese buying. All of it points to one conclusion. The crash was engineered to shake out weak hands and accumulate physical at lower prices. And it worked. Retail panicked. Retail sold. And now institutions are buying. But here's the thing. The game isn't over. The squeeze is still coming. Because the fundamentals haven't changed. COMEX inventory is still at 113 million ounces. China is still restricting exports. Industrial demand is still at 680 million ounces per year. Solar is still growing. EVs are still growing. AI is still growing. None of that changed. The only thing that changed is the paper price. And paper prices are temporary. Physical fundamentals are permanent. So the question isn't if silver squeezes, it's when. And my bet? Sometime between March and June. If COMEX inventory drops below 100 million, if China holds export restrictions, if physical premiums stay elevated, then the squeeze happens. And when it does, 78 will look like the deal of the century. But I want to be clear. This is not financial advice. I'm not telling you to buy silver. I'm not telling you to hold silver. I'm not telling you to sell silver. I'm showing you the data. I'm showing you the patterns. I'm showing you what the big players are doing. And then you make your own decision. Because at the end of the day, it's your money. It's your risk. It's your responsibility. All I'm doing is connecting the dots. And the dots say this crash was intentional. The dots say institutions are accumulating. The dots say a squeeze is coming. But when? How high? How long? Nobody knows. Not me, not Citi, not JP Morgan, not anyone. So manage your risk. Have a plan. Don't bet money you can't afford to lose. And don't listen to people who are certain. Because in markets, certainty is a lie. The only certainty is uncertainty. The only guarantee is that nothing is guaranteed. So stay flexible, stay disciplined, and stay informed. That's how you win. If you found this analysis valuable, hit the like button. Subscribe for more deep dives into what's really happening in the silver market. Drop a comment with your thoughts. Do you think they crashed it on purpose? Or am I seeing conspiracy where there's only chaos? Let's discuss. And remember, I've linked all my sources in the description. COMEX data, CFTC reports, Chinese customs, physical dealer premiums. Everything is sourced. Everything is verifiable. Because I don't do rumors. I don't do speculation. I do data. Thanks for watching. See you in the next one, in the next